Good evening, everyone. My name is Kathleen Prokop. I am a volunteer last year for tax preparation for the year 2020, where the worker worked in 2019. Now, for tax preparation in 2021, from 2020, there is what you call Secure Act of 2019. Important changes for the year 2021 tax preparation. The changes include in the Secure Act of 2019, setting every community up for retirement enhancement, that's secure, which is part of the further Consolidated Appropriation Act 2020 as summarized below. So there are certain taxable non-tuition fellowship and stipend. And the tax year beginning after 2019. This is certain taxable tuition, fellowship, and stipend payments are treated as compensation for the purpose of IRA contribution. So that means compensation will include any amount included in gross income and paid to act in the individual's pursuit of graduate and postdoctorate study. I do believe all this means is the compensation of the non-tuition fellowship and stipend for the purpose of IRA contribution is uh, is a they are treated as compensation for the purpose of IRA contribution, and it will be included in the gross income. So, but this is only for the graduate or postdoctoral study. So I think what this means is if there would be a contribution in the IRA, that would be the non-tuition fellowship and stipend payments. They have to be included in the gross income. Okay? Now, repeal of maximum age for traditional IRA contribution. So many older taxpayers can now choose to contribute some or all other compensation to a traditional individual retirement arrangements. That's IRA, individual retirement arrangements. So what this means is there are older taxpayers. Now they choose to contribute some or all of their compensation to a traditional individual retirement IRA. So what does this mean? Starting in 2020, there is a new law eliminated the long starting 70 and a half age limit for making contribution to traditional IRA. So there is no age limit for contribution to Roth IRA. So the result, people over age 70 and a half are still working, and running a business can now choose to contribute to a traditional IRA beginning in 2020. So, a qualified charitable contribution QCD can be made by a taxpayer who is age 7.5 or older. That's unchanged. So that means that the qualified charitable distribution that is made by taxpayer age 70 and a half, that's not unchanged. But the excluding portion of the qualified charity distribution is reduced by IRA deductions once a taxpayer attains the age 70 and a half. So the provision applies cumulative for tax years beginning after 2019 as to both distributions and deductions. So what that means is when there are excluded portion of qualified travel distribution, so that means there is some exclusion portion. The deduction is reduced by IRA deductions once a taxpayer attains age 70 and a half. Okay? This provision applies cumulatively for taxpayers beginning after 2019 as to both distributions and deductions. That is now if there is an excluded portion, and that is attain age 70 and a half. And then there would be a penalty-free withdrawal from retirement plans for individuals in case of birth or child or adoption. Beginning in 2020, the IRA owner or a participant in a workplace defined contribution plan. Let me repeat that. Beginning in 2020, an IRA owner or a participant in a workplace defined contribution plan, such as 401k or 403b plan, can withdraw up to $5,000 for the birth or adoption of a child without incurring the usual 10% additional tax on early distribution. So that's clear. The distribution must be made within 1 year after the child is born or the adoption is finalized and cannot be from defined benefit plan. Without incurring the usual, and cannot, or adoption is finalized and cannot be from defined benefit plan. So what does that mean? Someone who birthed or adopted a child may use or can withdraw up to $5,000 for the use of birth expense and adoption expense. And what else is there? Anytime after receiving the distribution, so after you receive your distribution, that means you withdraw from your contributions. An IRA owner or plan participant may generally recontribute any portion of that distribution as a rollover contribution to an eligible retirement plan. So you can put it back into a retirement plan as a, let me see, so you can contribute back, including IRA. The term eligible adoptee means any individual other than a child of the taxpayer's spouse. So adoptee, which is not a child of the spouse. So if you married a woman or a guy that has a child and you adopted it, who has not attained age 18 or physically or mentally incapable of self-support. So that is a term eligible adoptee. Other than. So that means other than a child of a taxpayer's spouse. Now, required minimum distribution RMDs. The required minimum distribution our age increased from 7.5 to 72 years for taxpayers turning 70.5 after December 31, 2019. So after December 2019, uh, um, if a taxpayer 70th birthday is July 1, 2019 or later, they do not have to take withdrawal until reaching age 72. For those who were age 7.5 or younger on January 1, 2022, their first required minimum distribution is not due until April 1 of 2020. After they turn age 72. For example, for those who turn 72 on July 1, 2021, they must take for their first RMD for 2021 by April 1, 2022. And their second RMD for 2022 by December 31, 2022. And so forth, following December 31, 2023, their third contribution, they must do it by December 31, 2022. Then if it's 2024, by December 31, 2023. The modification of required distribution rules for designated beneficiaries. So there are new required minimum distribution rules for designated beneficiaries upon the death of the IRA owner after December 31, 2019. So it says all distribution must be made by the end of the 10th year after the death, except for distribution made to certain eligible designated beneficiaries. So there is a restriction, which means except a distribution can made to certain eligible designated beneficiaries. So there are designated beneficiaries that they don't have to take all of the inheritance by the end of 10 years. Difficult of care payments. Beginning of 2019, taxpayers can elect to increase their compensation for difficulty of care payments that are excluded from gross income for the purpose of non-deductible IRA contribution. That means they can elect to increase their compensation. That means they can withdraw more. For difficulty of care payments, that means they have difficulty in paying, that are excluded from gross income. So there are those excluded in their income for the purpose of non-deductible IRA contributions. Expansion of Section 529. more expenses now qualify for tax-free and penalty-free withdrawals from a qualified tuition program. So when you withdraw, the owner of the IRA, also known as 529 plan, they are now qualified for tax-free and penalty-free withdrawal. So that means they don't have to pay taxes on it, and from withdrawals for a qualified tuition program. Amounts can be withdrawn to pay principal or interest on a designated beneficiaries or their sibling student loan. So they can use this withdrawal to pay interest or principal to a designated beneficiary or sibling student loan. The amount of distributions for loan repayments in individual is limited to $10,000 lifetime. Interest paid with these funds does not qualify for the student loan interest deduction. In addition, a 529 plan cannot be used to pay qualifying expenses for a designated beneficiary to participate in an apprenticeship program that is registered and certified by U.S. Department of Labor. The qualifying expenses are expenses for required fees, books, supplies, and equipment. So that's what they can use to pay. If there is an apprenticeship program that requires fees, books, and supplies and equipment. Because these changes are retroactive to 2019, any distributions during 2019 that meet these guidelines also qualify for tax-free and penalty-free treatment. So it did not say, well, it says retroactive from 2019 when they filed taxes in 2021 from 2020. There is no tax, they qualify for tax-free and penalty-free treatment. Now, if you need this information, you can go to Internal Revenue Service and you can Google Secure Act of 2019 in the IRS webpage. So thank you so much. Hope this helped. Remember to file your taxes for those who filed taxes. And also the ITIN. Important change this year is I-10's ITIN not used in the last consecutive tax years. If an individual taxpayer identification number was not included in a U.S. federal tax return at least once for tax years 2017, 2018, or 2019, the ITN will expire on December 31, 2020. So for 2017, 2018, and 2019, they did not use their ITN. That's 3 consecutive years. It will expire on December 31, 2020. Effective taxpayer need to take action to renew if it will be included in a USA Federation tax return. So if this would be, okay, that's because it's 2020 for 2021 taxpayer. So that means it expired on December 31, 2020. They cannot file use the ITN in 2021 tax preparation. ITNs with a middle digit 88 will expire. ITNs with middle digit, the fourth and the fifth position, 88, will expire December 31, 2020. So ITNs will middle age digit 90, 91, 92, 94, 95, 96, 97, 98, or 99 that were assigned before 2013 and have not already been renewed will also expire at the end of the year, December 31, 2020. Taxpayers with these ITNs need to take action to renew if it will be included in a U.S. federal tax return filed in 2021. So thank you so much. There are also, and you can get this information in the Internal Revenue Services, IRS, and you need to Google ITIN. Thank you so much. I have some more to say, but about the new changes this year, 2020, tax preparation 2021. And so please look for my YouTube opinion contribution. Thanks. Bye.